Am I crazy for having 5 stock accounts? What if I told you by doing this, it has increased my investment returns drastically? Let's look into it, shall we? Welcome back, mindful investors. I'm just here to share some ideas that has made or saved me some money. Back in my early days of investing, I only had one account, and everything was mixed in there. My long-term dividend stocks, rocket growth stocks, speculative penny stocks, options play, premium harvesting, etc., etc., etc. Everything was in there in one portfolio. And at the end of the year, I got this one profit and loss number. And this number should represent how well I've done for the whole year in my investments. But wait a second. That doesn't really tell the complete story. Let's use the school GPA analogy here. If someone has a GPA of 3, then he's a B student. But what if I told you that this student has scored 100% in 4 of the courses, math and sciences, but only 60% in the social arts? Would you still consider him as an average student? The whole concept of blending everything into one number can't justify a person's strengths and weaknesses. I know, some of you may say that I recall every single one of my wins and losses. But what if the number increases to like 100 plays per year? Then isn't it better to be able to visualize it instead? In my case, since I implement 4 different styles of investing, I wouldn't have a clue as to which style has performed the best if everything is blended together. Let's say for the end of the year, the number came out to be plus 20%. But what if I had 100% returns in my growth stocks, but minus 80% in my rest of the 3 styles? Then wouldn't I allocate less to the styles that are losing money? This concept I use is called compartmentalization.
6.5 hours later.
This concept I use is called compartmentalization. It's very simple. By putting things into different bins, then we can accurately assess them individually. Now we'll move on to the sketchboard. So we already gone through 4 of these accounts. 1, 2, 3, 4. The first one is the drip account, the dividend drip account. And then the second one is the all-weather portfolio. The third one was the growth stock portfolio with all the tech stocks. So that's our growth tech. And then the fourth one is a speculative with the options. So these were the 4 portfolios we gone through. I already made videos as to why I have these 4 portfolios and what the strategy is within each of them. For the dividend stock portfolio, we have this drip program where whenever we get dividends, we just reinvest in itself. So we have this little loop. Whatever dividends we get, we'll reinvest itself and buying more shares, and therefore getting more dividends and getting more shares and more dividends. That's the definition of the snowball effect. You can check out my Warren Buffett snowball strategy video if you want to learn more. For the all-weather portfolio, we have 5 holdings there. Only GLD doesn't pay a dividend. All the other medium-term, long-term bonds, QQQ, and VTI, all of them pay a dividend. And whatever I get there will reinvest in itself as well. For the growth tech stock portfolio, there was only 2 stocks that pays a dividend. And it was Apple and Microsoft. So whatever I get there will reinvest in itself as well. So whatever I get in these 3 portfolios will reinvest in itself. And I'll never cash it out. I'll just let these grow. For my speculative portfolio, there are dividends there as well because sometimes I hold stocks like Apple as I showed last time and they give out dividends. So this dividend will reinvest in itself. And I also sell premiums, as in selling call and put options, as I mentioned in the last video. And that will also reinvest in itself. And the third one is capital gains in my covered calls. There was a Fiverr example as stated, where I already had capital gains in there and I sold the covered call. And if the option gets executed, then I realize some capital gains. And whatever I get there will remain in this account. And the fourth avenue is my long shots. So as you can see, these 2 holdings, both Amazon and Shopify, I already doubled my investments in my long shot, long call option. And that remains in this account. So this account has 4 revenue streams. And what do I do with this? Is diversify across these portfolios. For my dividend stock portfolio, every single month, I put in like 3 to 5K in there and accumulate more shares here within this ecosystem. For my all-weather portfolio, every single month, I plan to put 5K as well. And in that video, I already stated that I'm going to double everything in that portfolio. I'm going to leverage it 100%. I just started this portfolio last month, and so far it made, $143, about a 3% gain. I'm going to watch it for the next year or 2 years and see if it's worthwhile to keep this account. For this growth tech stock portfolio, it's a TFSA account, so I can't put that much money in it. I can only put 6K per year and let it grow there. So this is my 4 portfolio strategy. As I mentioned before, these are all black hole portfolios where I only fund it and I never sell to cash anything out. There's also a 5th portfolio, which I haven't talked about. We'll do that in a future video, I believe in a couple weeks, where I do China stocks and IPOs. Now let's take a look at the risk versus reward on each of the portfolios here. So if we draw a line, less risk, most risk. In my eyes, the dividends account is definitely the least risky. It doesn't matter if the whole market tanks by 50%, you'll still get dividend payouts from the companies because there is zero chance that all the companies will go bankrupt and cut all its dividends. Zero chance. You can mark my word for that. The next one should be the all-weather portfolio, where we calculated that we would get about a 20% gain per year over the long term. For the dividends account, we would expect 7 to 10% with the dividends. And then now we have the growth stocks, where it's very possible to get 20 to 50% gains per year. As we can see from the 5-year chart, the Nasdaq index was at 4,200 5 years ago, and now is at 12,000. It's almost tripling up within the 3-year time frame. I'm not saying that history will repeat itself. Optimistically, it could be 20 to 50% per year over the long run. And for my spec portfolio, this is by far the riskiest. It can get 100% in a month easily, or it can go to 0, possibly. With my managed risk, and since there's so many revenue streams within the same portfolio, I can just use this recurring income and take the free bets for the long shot. As you can see in my last video, where I collected $4,000 from Tesla, and just to make a long shot 2 years out for $7,000. And right now I believe that's up maybe $1,000, but that doesn't matter. I'm going for the long shot, 5x, 10x on that play. So what do you think about this 5-stock portfolio approach? Does it make any sense? Should I get rid of any of them? I mean, if this LWP doesn't work out after a year or two, it doesn't even beat the index, then I might just take it to the barn and shoot it. And then I can just funnel more money into the dividends account and the growth tech stocks, which are proven to me. This, I'm trying to build a new stream. This one makes the most sense to me. Now we'll talk about passive versus active investing. These 2 accounts of dividends and all-weather portfolio is the most passive. What I do is just put money in every single month and distribute across the holdings for these 2 portfolios. For the growth stocks, I already picked my 11 stocks that I love, and I'm going to hang on to it forever. But there are some active plays within this portfolio where I do long calls and covered calls to eke out more returns. For the spec portfolio, this is by far the most active. I think on average, I have 50 to 100 plays per month in this portfolio. And each of the plays can range from value. I make so many plays on like so many different stocks. As you can see here, there's some stocks I never plan on owning. It's an interesting idea, but all I want to do is collect as premiums, like Chewy or Clorox or DraftKings or Domino's Pizzas. It's solid stocks that I don't plan on owning in my portfolio, but I just want to make a play to collect some money. Because everything is speculative. And in order to fund these 3 accounts, I need to generate 10K a month income within the spec portfolio. And let me know if you like this kind of sketches. I personally like it. I don't know if you can see it clearly. I'll try to use the thick markers here. And sometimes it's like blah, like this. It's not the neatest. I mean, I can go back to my animations to make everything perfect. Sometimes I need to sketch everything out to convey the idea. I don't know if it makes any sense to you. Let me know down below what you like, what you don't like about it, if I'm crazy about this 5 portfolio. So what do you think about my 5 portfolio approach? Let me know in the comment section down below. As always, thanks for watching. Hit the like and subscribe button if you found any value. Take care, and I'll see you in the next one.